Hi, Mike L. Mahler, recovering CPA, back with this next lesson in this mercifully brief introduction to financial accounting. In the last lesson, Debits and Credits Part 1, I introduced the record-keeping fundamentals, the T-account structure, and the basic transaction posting rules. In this lesson, Debits and Credits Part 2, we'll use those rules to learn how to record common business transactions. In Part 1, we learned that every transaction includes a debit in one account and an offsetting credit in another account. Debit means left side of the T account and credit means the right side. A debit or credit will increase or decrease an account's cumulative balance depending on the nature of the account. For assets and liability accounts, debit transactions increase the balance and credits reduce the balance. For liability, equity, and revenue accounts, it is the opposite. Credit transactions increase the balance and debit transactions reduce the balance. Now that we know the debits and credits impact their general ledger accounts, we can learn the rules for specific types of transactions. The most common transactions in a business day-to-day operations are those that involve revenue and expense accounts, so we'll start with these. First, let's look at transactions associated with earning revenue. When a firm sells products or provides services, it earns revenue, so a revenue account must be increased. Increases in revenue accounts are recorded as credits, and the offsetting debit is always to an asset account, often cash. In the general journal, you will record the transactions like this. Sometimes the offsetting debit is to accounts receivable instead of cash. An accounts receivable is a customer's or client's promise to pay for goods or services it has previously received. A firm may provide a service or a shipment of a product before they send an invoice to the customer requesting payment. These unpaid invoices make up accounts receivable. This brings us to our next type of transaction. When the firm receives a payment from the customer to repay their account, accounts receivable receives a credit to decrease the balance, and cash receives the offsetting debit, which increases the balance. The transactions would be recorded like this. Now, let's look at an expense transaction. When a firm incurs an expense account must receive a debit. The offsetting credit is often to cash, and the transactions are recorded like this. But what if you pay for an expense with a credit card instead of cash? Or if you aren't required to pay on the spot? In that case, the offsetting credit is to accounts payable rather than cash. An accounts payable is a liability the firm incurs in exchange for goods and services it receives. Unpaid invoices or debts for the incurred expenses are examples of accounts payable. This leads to our next transaction, making a cash payment to reduce an accounts payable. For these transactions, accounts payable receives a debit to decrease the balance, and cash receives the offsetting credit, decreasing its balance as well. Record the entries like this. Now we know how to record typical revenue and expense transactions. These transactions occur frequently, often several times a day. Less frequently, a business will be involved in financing transactions. In a financing transaction, the firm is either receiving or repaying a loan. Let's start with receiving a loan. When the business borrows money in the form of a loan, the cash account is debited, increasing the account balance, and the notes payable account is credited, also increasing the balance. The entries are recorded like this. Now let's look at repaying that loan. Repaying a loan involves paying back the lender for the original amount borrowed. That amount, or the portion of it still owed, is called the principal. When the firm makes a repayment of principal, the notes payable account is decreased, debited, and the cash is decreased, credited. We record this transaction like this. Loans often involve interest payments in addition to the principal, and interest transactions are considered expenses. For these transactions, we debit an expense account, increasing the balance, and the offsetting credit is to the cash account, decreasing that balance. The transactions look like this. Another class of relatively infrequent transactions are those involving the acquisition of fixed assets. When a firm acquires a fixed asset, such as equipment or office furniture, the appropriate fixed asset account is increased or debited. If the firm is paying for the asset outright, the offsetting credit is to the cash account, decreasing that balance. But if payment for the asset will be deferred until later, the offsetting credit is to a liability account, notes payable, and the account balance increases. Finally, there are the less frequent transactions between the firm and its owners. Usually these involve cash transfers to and from the owners. If an owner is contributing cash to a firm, cash is debited and an appropriate equity account, such as owner's equity, is credited. The transactions are recorded like this. When a firm distributes cash to owners, cash is credited and an account such as owner's draws is debited. The transactions are recorded like this. Now that we know the rules for recording the most common transaction, let's practice with an example. On January 3rd, Hamlet, an MSW, opens a psychotherapy clinic and contributes $5,000 to their business. The $5,000 is an increase to cash, so cash must be debited. Since the cash comes from the owner, the credit must be recorded in an equity account. On January 3rd, Hamlet borrows $15,000 from his friend Rosencrantz to furnish his office and defray other startup costs. The business receives a $15,000 increase in cash and now owes $15,000 in notes payable. On January 4th, Hamlet pays $1,500 rent for his office. Cash is decreased and an expense, rent, increases. On January 5th, Hamlet purchases office furniture for $9,100. Office furniture is an asset, so this asset increases while another asset, cash, decreases. On January 29th, Hamlet collects $8,000 in patient fees from his HMO. An asset, cash, increases. He has earned these fees, so the offsetting entry is to increase revenue. On January 30th, he draws $3,500 for living expenses. Since Hamlet is drawing the money to defray personal expenses, the disbursement is considered an owner's withdrawal, which is a decrease in owner's equity. On January 31st, Hamlet repays Rosencrantz $3,000 principal and $100 interest on the previously recorded loan. The total payment is $3,100, so clearly an asset account, cash, decreases by $3,100. But there are actually two other accounts that need to be offset in this transaction. The principal on the note decreases by $3,000, which means a decrease in a liability account, and the $100 interest is an expense, which means an increase in an expense account. This is one form of the posting for this transaction. Alternatively, the transaction could have been broken into two separate entries like this. As long as the total debits and credits in the entry are equal and the elements of the transaction are related to the same event, either method of posting is acceptable. Now here are the T accounts after these transactions have been posted. So click here for the next lesson.